Imagine waking up tomorrow and every single smartphone, every military jet, and every artificial intelligence system on the planet is suddenly completely frozen, not because of a massive cyber attack, not because of a global power outage, but because one single country decided to close the world's most invisible toll booth. Right now, we are standing on the edge of a massive market inflection point. The prices of highly specific, obscure commodities are skyrocketing, and it is sending shockwaves through the global financial system. The mainstream financial news is completely obsessed with the latest tech earnings and artificial intelligence hype. They are looking at the shiny new car, but they are completely ignoring the fact that someone else owns the only gas station for thousands of miles. To understand exactly what is happening right now and how to protect your money, we have to look back at one of the most brilliant and subtle geopolitical moves in modern history. Let me take you back to the year 1992. The leader of China at the time was Deng Xiaoping. He was a man who thought in terms of decades and centuries, while Western politicians thought in terms of 4-year election cycles. During a famous tour of southern China, he made a statement that went largely unnoticed by the Western public, but sent a quiet chill through the halls of global intelligence agencies. He simply said the Middle East has oil, but China has rare earths. At the time, very few people outside of chemistry laboratories even knew what rare earth elements were. Let me explain this using a very simple analogy. Think of baking a massive, beautiful cake. The flour and the sugar are like steel and plastic. You need a lot of them to build the basic structure of a car or a building. But the rare earth elements are like the yeast. You only need a tiny microscopic amount. But without it, the cake simply will not rise. Without these specific elements, modern technology simply does not exist. They are the absolute magic ingredients that make magnets in wind turbines spin. They are what allow the screen on your smartphone to display vibrant colors. Most importantly, they are the vital components required to manufacture the advanced semiconductors that power modern artificial intelligence and sophisticated military defense systems. Fast forward to today, and Deng Xiaoping's vision is our absolute reality. China processes the vast majority of the world's critical materials. They have built an incredible, unbreakable grip on the supply chain. Now we are seeing extreme geopolitical drama erupting around the globe, especially with tensions involving Iran and the broader Middle East. In response to this friction, the prices for these incredibly vital elements are surging. It is as if the owner of that only gas station in the desert just saw a massive storm approaching and decided to multiply the price of gas by 10. This is not just a tiny temporary bump in the road. This is a massive structural earthquake. We are witnessing a brutal feedback loop. Geopolitical instability happens. The supply of critical raw materials gets squeezed. The input costs for massive tech companies and defense contractors spike violently. When it costs much more to build a computer chip or a fighter jet, the profit margins of these massive companies get completely crushed. To truly grasp how dangerous this is, we need to talk about an ancient concept from Buddhist philosophy called Indra's net. Imagine a massive, spectacular spider web that stretches out to infinity in every single direction. At every single intersection of this infinite web sites a perfectly polished, glittering jewel. If you look closely at any one single jewel, you will see the reflection of every other jewel in the entire net. If you pluck just one tiny string of this web, the vibration ripples out and shakes every single jewel in existence. This ancient philosophical concept is the absolute, perfect description of our modern global macroeconomic system. 50 years ago, if a factory in a distant province of Asia shut down, nobody in New York or London would even notice. Today, if a tiny facility that refines gallium or germanium slows down its production, the most advanced artificial intelligence startups in Silicon Valley could literally go bankrupt. We built a global economy optimized purely for speed and cheap prices. We outsourced everything. We handed over the keys to the kingdom to save a few pennies on the dollar. Now the bill is coming due. The geopolitical conflict we are seeing right now is plucking the strings of Indra's net, and the entire global supply chain is violently shaking. This brings us to a terrifying economic monster that most investors alive today have never actually faced. It is called stagflation. Let me translate this into plain English. Normally, in a healthy economy, prices go up a little bit because people are buying things and businesses are growing. If the economy crashes, prices usually fall because nobody has any money to spend. But stagflation is a horrific mutant scenario. It is what happens when prices violently explode higher, but the economy actually stops growing and starts shrinking. Imagine trying to drive your car on the highway. You are pressing the gas pedal all the way down to the floor, but your parking brake is completely locked. The engine is screaming. Smoke is pouring out, but you are barely moving. That is stagflation. The surging prices of these critical materials act like that parking brake. It forces inflation higher. Central banks panic. They cannot lower interest rates to help the economy because inflation is too hot. This creates what the institutional analysts at Evercore ISI are calling a week of maximum uncertainty. When maximum uncertainty hits, the market does something very predictable and very dangerous. This brings us to the psychology of the retail investor versus the psychology of the institutional titan. In the year 2002, a brilliant psychologist named Daniel Kahneman won the Nobel Prize in economics. He did not win it for complex math equations. He won it for proving that human beings are fundamentally irrational. When it comes to money, he wrote a groundbreaking book that completely changed how we understand the stock market. He explained that the human brain operates on two totally different systems. System 1 is fast. It is emotional. It is based on pure survival instinct. When early humans heard a rustle in the bushes, System 1 made them run away instantly so they would not get eaten by a tiger. System 2 is slow. It is deliberate. It requires deep, heavy concentration and logic. When you solve a difficult math problem, you are using System 2. Daniel Kahneman proved that when investors lose money or get scared, they completely abandon logic and let the emotional fast system take over completely. This is what we call herd bias. Right now, the herd is absolutely terrified of the macro uncertainty. So they sell everything indiscriminately, but at the exact same time, they suffer from extreme tunnel vision. They are completely hypnotized by the endless hype surrounding artificial intelligence. They read the headlines about NVIDIA and Palo Alto networks, and they blindly chase the end product. They want to buy the shiny artificial intelligence software, but they are completely ignoring the incredibly fragile supply chain of rare earth, minerals required to actually run that software. The herd is running away from the smoke while completely ignoring the fire. But the smart money does exactly the opposite. The massive institutional players and hedge funds are using Kahneman's slow logical system 2. Evercore ISI explicitly stated that they are waiting patiently. They are not panicking. They view this massive wave of fear and indiscriminate selling as a golden opportunity. The smart money knows that this is a first-order effect. The first-order effect is simple. War happens. Commodity prices go up. Retail investors freak out and sell their broad market index funds out of pure terror. But the institutions are playing chess, while the retail herd is playing checkers. They are looking at the second-order effects. Let us break down exactly what the smart money is doing right now. They look at the semiconductor sector. Semiconductors are the brains of every computer on Earth. But these companies are now facing massive input costs because the raw materials from China are getting insanely expensive. So the smart money slowly rotates their capital away from the vulnerable chip makers. But where do they put that money? They move it into the exact sectors that benefit from this chaos. They buy defense contractors. Why? Because when global conflict escalates, governments authorize massive blank checks for military spending. The demand for advanced weaponry skyrockets, and these defense companies have massive pricing power. They also buy the mining and materials, companies that actually pull these essential commodities out of the earth. As supply gets tighter and prices rise, these raw material producers make absolutely massive profits. This is the ultimate contrarian play, and it goes even deeper. We are now entering the third-order effect. For the last 40 years, the world operated on a system of intense globalization. We spread out our supply chains all over the globe to find the absolute cheapest labor and the cheapest materials. But this commodity shock is forcing Western governments to completely wake up. They realize they can no longer rely on adversarial nations for the most important ingredients of their national security and economic future. We are witnessing the birth of massive policy shifts called onshoring and friendshoring. This is a massive reversal of globalization. Imagine you used to share a giant kitchen with 50 roommates because it was very cheap. But one day your roommates start threatening to lock the refrigerator and hide the stove. You would immediately decide to build your own kitchen in your own room. It will cost you a lot more money up front to buy your own appliances, but you will have total absolute security. That is exactly what the United States and its allies are doing right now. They are spending hundreds of billions of dollars to bring manufacturing, refining, and semiconductor fabrication back home, or to extremely friendly allied nations. This is not a temporary trend. This is a secular multi-year supercycle. The companies that build these new, resilient, domestic supply chains are going to be the absolute mega winners of the next decade. So how do you actually survive and thrive in this exact environment? How do you position your portfolio when inflation is sticky, growth is slowing, and the global supply chain is fundamentally rewiring itself? You need to look at the Titan playbook. Institutional wealth managers rely on a specific asset allocation model, designed specifically for this type of intense macroeconomic stress. It is called the 55-35-10 seesaw. It is designed to perfectly balance aggressive growth with absolute bulletproof defense. Let us break it down so you can understand exactly how to implement it. 55% of your allocation goes into strategic equities, but you cannot just buy the whole market blindly anymore. You have to be surgical. You tilt this portion toward the sectors that have real pricing power and are shielded from the geopolitical shockwaves. You look for heavy exposure in defense ETFs like the iShares, U.S. Aerospace and Defense ETF, ticker symbol ITA. This fund holds the massive contractors that build the jets and the missiles. You also want exposure to the basic materials and mining sector. Consider an ETF like the SPDR S&P Metals and Mining ETF, ticker symbol XME. These are the companies that will profit massively as the world scrambles to find new sources of critical elements outside of China. On the flip side, you must be incredibly cautious with broad semiconductor ETFs like SMH. The narrative around chips is rapidly shifting from boundless, infinite growth to severe input cost anxiety. The next 35% of your portfolio must be allocated to safe defensive assets. This is the heavy anchor that keeps your ship from capsizing during the storm. In a period of stagflation and maximum uncertainty, capital always flees to safety. This means high-quality government bonds and fixed-income instruments. Because inflation might stay sticky for longer, bond yields will likely remain very attractive. You can look at ETFs that track medium-term treasury bonds to lock in those safe yields, while protecting your principal from wild stock market swings. Finally, the last 10% is the most crucial part of the entire strategy. 10% must be held in pure liquid cash. Cash is not trash. Cash is absolute pure optionality. When the market panics and the retail herd sells perfectly good companies at a 50% discount, your cash is the ammunition you use to buy the dip. The institutions use their cash to scoop up generational wealth, while everyone else is paralyzed by fear. We have covered massive ground today. We traveled from the subtle warnings of Deng Xiaoping in the 1990s to the ancient philosophy of Indra's net. We exposed the deep psychological flaws that cause retail investors to panic. And we revealed exactly how the smart money uses cold, calculating logic to profit from geopolitical chaos. We are standing at a major crossroads in economic history. The era of cheap money and perfectly smooth global supply chains is officially completely over. The world is fracturing. The critical materials that power our artificial intelligence and our national defense are becoming the new oil. The market is slowly waking up to this reality, and the volatility we are seeing right now is just the beginning of a massive repricing of global risk. Do not let the daily headlines distract you. Do not let System 1 emotional panic dictate your financial future. The investors who understand these massive macro forces and position themselves accordingly will build massive generational wealth over the next 10 years. Those who stay trapped in the herd will simply be swept away by the changing tides. Stay incredibly disciplined. Stay widely diversified. And above all else, let time and logic compound in your absolute favor. In 40 years of watching these massive market cycles play out, the disciplined, calculated investor always wins in the end.